CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
Welcome to CGS-CIMB, Asia's financial gateway. Here's how you can solve your questions regarding settlements. When must I make a settlement, and how can I check my settlement period? The purchase contract's due date varies from exchange to exchange. For example, for SGX listed trades, your trades will be due on trade date +2. What are the different modes of settlement? There are various modes of settlement: cash, electronic payments for shares (EPS), gyro, internet banking bill payment facility, multi-currency trust account, phone banking, telegraphic transfer, and check. You will have to choose your mode of settlement, if there are any. When will I receive my sales proceeds, and can I choose how I would like to receive them? In example, in what currency, via cash, checks, or any other means? Sales proceeds due will be paid on the day following the due date of the sales contract in accordance with the settlement mode that you have chosen. How do I settle my foreign share transactions in SGD instead of traded currency? And what would the exchange rate be? For settlement in SGD, it can be made via SGD check, EPS, gyro, or multi-currency trust account. Settlement in SGD, AUD, HKD, MYR, USD, GBP, RMB, and JPY can be made via multi-currency trust account, telegraphic transfer, SGD, RM, local USD checks. You can choose to settle your foreign share transactions by simply selecting SGD as your settlement currency via the order pad. The exchange rate is determined at the time your order is executed, online or offline. If you decide to change the settlement currency after the order is executed, you may call your trading representative or our call center to book an exchange rate. You may also visit our cashier to pay in SGD, and the rate will be determined at the point of payment. Can currency conversion be done online prior to settlement? Online currency conversion is only available for cash upfront trading (CUT) accounts. Thank you for choosing CGS-CIMB. Welcome to CGS-CIMB, Asia's financial gateway. Here's how you can view your watch list. On mobile, tap on the menu button at the top right-hand corner of your screen and select Watch List at the bottom. Tap on the watch list you wish to view. On desktop, click on the watch list icon. Go to View Watch List. Select the watch list you wish to view, and you're done. Thank you for choosing CGS-CIMB.
Looking to access the U.S. market for all U.S.-listed stocks? Covering all U.S.-listed stock, Nasdaq Basic is the primary gateway for any firms accessing the U.S. equities market. We are helping and supporting any Asia-Pacific firms who need access to the U.S. market. With Nasdaq Basic, traders can access real-time U.S. equities quote and trade data cost-effectively and look at several key data elements for U.S. exchange-listed equities, including real-time best bid and offer, tick-by-tick price, and Nasdaq opening and closing prices, all at a fraction of the cost of consolidated alternatives. Nasdaq Basic is the leading exchange-provided alternative for real-time data coverage, includes NYSE, Nasdaq, and other U.S. exchanges, plus Nasdaq Basic can be implemented through a variety of investor tools, including watch lists, portfolio trackers, and dynamic tickers. To find out more, visit our website or email dataapac@nasdaq.com.
Think you're driven enough to succeed? Win a brand new Tesla Model 3 in just 3 easy steps. Open a CGS-CIMB trading account and start trading your way to awesome prizes. Participants can trade any of our 6 products to earn tickets. The more you trade, the better your chances. Earn as many tickets as possible from July to December to win the latest and greatest from Apple and be eligible for our grand prize, a Tesla Model 3. What's more, we've also lined up a series of webinars throughout the campaign period to help you become a savvier investor. Don't miss out on these free sessions. Register and level up your trading play. Open a CGS-CIMB account and start trading today.
Stock markets may be about to get more volatile, and here are 5 reasons why. Number 1, the pandemic. A new wave of infections may have already started at the global level. Infections are surging in the United Kingdom, raising the likelihood of a similar surge soon in the United States. Case numbers are also turning in Asia. This will slow or at least temporarily halt reopening. Number 2, the high growth, low inflation narrative will start to wear a bit thin. The Federal Reserve and the US Treasury continue to chant that mantra that inflation is transitory. But US inflation, both headline and core inflation, has not taken a single backward step since the start of the year. Number 3, now, even as inflation pushes higher, the economy will find it harder to impress with an encore performance. The 2021 economic recovery is already in the price, past tense. And as we progress through second half of 2021, the markets will look more at the slower economic growth rates expected for 2022. Number 4, corporate earnings also face that same problem of producing an encore capable of impressing the market. Just as we have seen peak economic growth, we are likely also to have seen peak earnings growth. The market is expecting 37% earnings growth for 2021. This is almost at the 40% growth peak post the global financial crisis. Finally, number 5, there are hints of market discontent in the divergences between the S&P 500 and the Dow Jones Transportation Index, and between the S&P 500 against that risk-on, risk-off currency pair, the Aussie yen. They are not confirming the rise in the S&P 500 since June. The bull market is unlikely to be over yet, but a correction is a growing risk.
CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
Looking to access the U.S. market for all U.S. listed stocks? Covering all U.S. listed stock, Nasdaq Basic is the primary gateway for any firms accessing the U.S. equities market. We are helping and supporting any Asia-Pacific firms who need access to the U.S. market. With Nasdaq Basic, traders can access real-time U.S. equities quote and trade data cost-effectively and look at several key data elements for U.S. exchange-listed equities, including real-time best bid and offer, tick-by-tick price, and NASDAQ opening and closing prices, all at a fraction of the cost of consolidated alternatives. NASDAQ Basic is the leading exchange-provided alternative for real-time data coverage, includes NYSE, NASDAQ, and other U.S. exchanges, plus NASDAQ Basic can be implemented through a variety of investor tools, including watch lists, portfolio trackers, and dynamic tickers. To find out more, visit our website or email dataapac@nasdaq.com.
A very good evening to all of you. Thank you so much for joining us tonight and for being driven to learn with CGS-CIMB. Tonight, we will be covering the key US stocks to watch. The US markets remain hot this year, with major indexes hitting record highs, so I'm sure this will be an insightful session. Joining us today is Jay Gragnani, the Head of Research and Client Engagement for Nasdaq Dorsey Wright, and Bertram, the Group Head of Research and ESG for CGS-CIMB Securities. Both of them have years of experience between them and a lot of knowledge to share. I am Ping Mei, founder of Prosperous, and I will be your moderator for tonight. Just a quick little introduction on Prosperous. We are a new digital investment service and multi-asset platform created for millennials by millennials, and we are fully backed by CGS-CIMB, the #1 broker on SGX. Our platform offers 8 types of products and covers over 30 exchanges globally, and we are committed to bringing investor education to the forefront of everything that we do. So if you're looking for an easy-to-use global platform with investment insights, do check us out at prosperous.asia. Now, back to today's webinar. Both Jay and Bertram have teamed up together to talk about a very exciting and timely topic. Gain insights on the most bought stocks by volume and certain US stocks investors are holding. The speakers will bring a strategic fundamental analysis perspective to the table, discussing major US stocks and market themes, diving into who would be the likely winners from the reopening as the economy recovers and markets continue to rise. Let's welcome our first speaker for tonight, Jay Gragnani. Over to you, Jay.
Hello and good evening. It's great to be here. Thank you for joining us, and also thank you for having me on the call. The U.S. market, as was alluded to earlier, certainly has been on a tear, on a run, really since the market bottomed in March 2020 as a result of the COVID-19 pandemic. And here we are in July of 2021, and the market indexes continue to push to and continue to hit new highs literally this week as we're seeing those new highs coming out. And so from the backdrop, as we think about the U.S. equity markets today, just at a big picture perspective, the U.S. equity markets are an area, an asset class that we look at and we view as being the strongest from a relative strength perspective. And I'll dig into that a little bit more in a minute. Let me back up for a second and say, for those of you who are not familiar with Nasdaq Dorsey Wright, we are a registered investment advisor based in the U.S. that provides research tools and analytics to financial professionals as well as individual investors to help make better informed decisions or more informed decisions, specifically utilizing the point and figure method of technical analysis. And so everything that we do at Dorsey Wright as it relates to evaluating individual stocks that trade on not only U.S. exchanges, but trade on exchanges all over the world. We track all stocks that trade in the U.S. market, but we also track about 26,000 securities that trade on exchanges all over the world. So it truly is a global investment strategy that we provide. And we do that, again, through the lens of technical analysis. Very specifically, the point and figure technical and that form of technical analysis is the form that we utilize almost exclusively at Dorsey Wright. And it's nothing that we created. The methodology goes back to the late 1800s and Charles Dow being the first big proponent of the methodology. But Charles Dow was very much a fundamentalist at heart, but also had an innate appreciation for understanding the movement of individual securities, because sometimes there can be a disconnect between a fundamentally sound company and a stock that is going up in price, or vice versa. You might have a fundamentally sound company, but if there's more sellers out there selling the stock, then the price is going to go down. And so at the end of the day, what the point and figure methodology allows us to do is uncover the imbalances between supply and demand. It comes down to Econ 101. If there's more buyers out there for a particular good than there are sellers, then prices have to rise. If there's more sellers out there for a particular good than there are buyers, then prices have to fall. And if buying and selling pressure are equal, then prices have to remain the same. And that holds true across goods that we consume on a day-to-day, a week-to-week basis, whether it's food, whether it's clothing. If there's more buyers out there than there are sellers, then prices are going to move higher. Well, the same holds true for the stock market. If there's more buyers out there for a particular stock than there are sellers, then the price of that stock is going to move higher, and vice versa. If there's more willing sellers than there are buyers, then the price of that stock is going to fall. And so when we think about the markets today, there have clearly been more buyers out there than there have been sellers over the course of the past, I call it about 18 months or so. And that doesn't mean that prices haven't pulled back a little bit along the way. As a matter of fact, they have pulled back a little bit here and there, 4, 5, 6%. But on average, the U.S. equity market, as defined by the S&P 500, pulls back about 10% once every year and a half or so. So a 10% pullback in the equity market, in the S&P 500 index, across the history of the market is a very, very normal thing that happens about every 1.5 or so years. Now, with that said, we are basically right at that number. We're about a year and a half in from seeing a 10% pullback in the market. And so while we continue to see equities in general, especially U.S. equities, continue to be very, very strong, it's not to say that pullbacks might not happen. It would be a very normal thing at this point. All pullbacks that we've seen really over the past year and a half have been nothing but buying opportunities within this market. And as it stands now, pullbacks from here we would continue to view as buying opportunities. So that's one thing that I wanted to mention. One other thing that I wanted to mention before getting into some of the individual stocks, some of the big stocks that I wanted to talk about, some of the most widely traded and tracked stocks out there, and some of the most important stocks that we're watching today, is looking at the overall trends of stocks is very, very important to us. Obviously, the major indexes are in positive trends today, as defined by their point and figure trend charts. But it's not just the handful of big stocks that are carrying the indexes. As it relates specifically to the S&P 500, if we looked at all 500 of those stocks and said, how many of those, or perhaps what percent of those stocks are in positive trends today, that number is about 82%. I'll say about 82% of the stocks on the S&P 500 are in positive trends today. The only way a stock stays in a positive trend is continue to move higher in absolute price. So that in and of itself is a positive thing. Historically, numbers above 50% have been positive signs for the market, meaning when a majority of stocks are in positive trends, that has historically been a good sign for the market. When that number dips below 50%, that historically has been a weak sign for the market. So, the 82% number is certainly strong. It is backed off of its high. It got up to 92% actually earlier this year. So it's come down a bit, and we've seen some individual stocks in the S&P 500 move into negative trends, and we'll talk a little bit about those in a minute. But by and large, we continue to see a vast majority of those stocks in positive trends today. So with that kind of as the backdrop, let's go through and look at a couple of the individual stocks that we're paying very, very particular attention to, some of which for multiple reasons. This week, as we're having these discussions, this week is a very, very important week in terms of earnings amongst a lot of the big technology names. There's also FOMC, the Fed is in the U.S. is planning to make some announcements, and so there's a lot of eyes looking right now on some of these big tech names, as well as some guidance or just language out of the Fed. So with that said, let's start with Apple. Apple is the largest stock, the single most important stock in the S&P 500, the Nasdaq 100 index, just for the simple fact that it is the biggest market cap stock out there. Well, the good news for those indexes is we continue to see Apple push to new highs, continue to see Apple carry the market to new highs. And so if we look on the right-hand side, that is a point and figure chart of Apple. Column of X's simply represent the price is rising. A column of O's simply represent that the price is pulling back. What we pay attention to is those buy and sell signals that can happen along the way for more shorter term trading opportunities. So each time the price of the stock rallies higher than it did the previous time, you'll see a column of X's that exceeds the previous column of X's. So there's green boxes on the chart. For instance, back in April at $128, the stock returned to a buy signal after pulling back for a bit. It gave a second consecutive buy signal earlier this month at 138. Rallied to a high of 150, back and has reversed back up to make a higher bottom. So, this is very clearly a situation where demand remains in control of Apple. You'll also notice on the left-hand side of this table a 3 technical attribute reading. Every single stock that we track on the U.S. market is given a technical attribute rating 0 to 5, 5 being the strongest. 3 and better is what we consider to be a strong technical attribute name or an investment grade stock. So Apple is a stock that would be technically sound from our perspective. It's a stock that's trading in a positive trend. However, the one caveat that I would put on this is the stock has gotten a bit overbought on a near-term basis. You'll notice that it's trading up around what we would define as the top of the 10-week trading band. And that is just a measure of statistically overbought or oversold. If you look at the midpoint, or you think about a normal distribution bell curve for a second, and you draw it on the chart there, the midpoint would be dead center of that bell curve. The top is 3 standard deviations to the right, or 100% overbought. The left is, the bot point is 3 standard deviations to the left, or 100% oversold. The midpoint is where the stock wants to trade. That's essentially the 10-week moving average. When you get up to the top of that trading range, typically what that suggests is the stock is due for a potential pullback, or perhaps just a little bit of a breather. Doesn't suggest that any long-term impending sell-off is due, but it's a situation certainly that is worth watching as the stock has gotten a little bit overbought. If you're looking to buy it, maybe doing so on pullbacks or something along those lines. Otherwise, longer-term investors, this is certainly a stock that we would continue to rate as a hold here. Another name, Amazon, is another one of those stocks that is incredibly important, not only to the major indexes, but has become incredibly important to a lot of other industries out there in the market. Amazon has certainly been one of those companies that has been very, very disruptive to a lot of industries. Most notably, recently, has been very disruptive in the retail space. Really, last year, you saw a lot of that as retail stores were forced to close down. Brick and mortar stores were forced to close down. More commerce was being done online, and Amazon was certainly right there at the forefront of the online shopping capability for consumers. And so Amazon performed phenomenally well last year. However, for basically the past year, what you saw is Amazon really trade sideways, as did a lot of the big cap U.S. large cap technology names. They really, after a tremendous run in 2020, traded, consolidated a bit. Amazon was a little bit more pronounced in its period of consolidation for about a year, trading in a range from just around 2,900 up to about 3,500. So there were some trading opportunities in there, but at the end of the day, it was just big range. Just earlier this month, Amazon was able to break out of that range to the upside, which is a positive technical development on the chart. Has since reversed back up to make another higher bottom. Again, just like Apple, Amazon is what we would consider to be a strong attribute name at a 3 attribute name. But this breakout right here provides investors for potential entry points for those looking for or to gain exposure to a stock like Amazon. Keeping in what we would consider the growth arena, and certainly technology, Shopify is another name. It's been a very, very widely followed name. It's been a very, very important name for a lot of companies providing solutions. Shopify is a stock that is a 4 attribute name, so it's a strong technical attribute stock as well. As we can see on the left-hand side there, it's a stock that is in an overall positive trend and continues to push to new highs. And so when we look at a stock like Shopify, like a lot of other technology names, they went through, this one was a little bit shorter lived, but in June and earlier in July, period of consolidation and then breaking out to the upside. That, from a technical perspective, is a generally a positive, generally a bullish setup for an individual stock like that. And as we kind of look at some of these names in the growth or technology arena, another name that I'll mention is NVIDIA in the semi space. NVIDIA has been one of the stronger names in the semiconductor space with a 5 technical attribute reading. It has pulled back here recently. It's got some key support at 180, but it's pulling right back to where we would consider to be very normal levels for the stock toward the middle of that trading range. And, again, you saw a lot of consolidation out of some of these names kind of earlier this year in January, February, March. And then we've seen in the second quarter of 2021 and in almost through the first month of Q3 being July, we've seen a lot of these growth names really come back. There was this big trade at the end of last year, first few months of this year of value over growth, and that was a very dominant trend that had very meaningful impacts on the market and very real outperformance from value for a while. That has changed here recently over the course of the past few months, as a lot of these growth names have regained their footing, and you've seen growth really, these growth sectors, growth stocks really come back into favor in lieu of some of the more value-oriented sectors, and certainly technology being right there at the forefront of the growth-oriented sectors. I think it's also worth mentioning too, when you think about technology, technology has become such an important sector for the big market indexes. The S&P 500 is about 25% technology. It's about 60% in the Nasdaq 100 index. And so these big technology names certainly carry a lot of weight. And so, the market indexes, as you're continuing to see them to push to new highs, they're really doing so because these large cap growth names have really gotten back onto their footing and really started recontributed to a lot of the strength that they saw coming out of the correction lows of the COVID-19 sell-off from last year. With that said, there have been some individual names that we have looked at recently that have negatively diverged from the market. One of those names being Western Digital. Would be certainly within the technology sector. Western Digital is a name that went through a period of consolidation earlier this year, much like a lot of these other names, was able to push to new highs in June up at 78. But then by July had sold off. As the indexes were hitting new highs, Western Digital simply was not able to do so. And as a matter of fact, moved into a negative trend. So in July at $67, Western Digital moved into a negative trend, giving a sell signal that, their column of O's that falls one box below the previous column of O's is what we would call a sell signal on a point and figure chart. So it gave a sell signal. It then rallied, and then it has pulled back again to 62. The one bright spot I would say here on the Western Digital chart is that it has been able to hold initial near-term support at 62, but the long-term trend of this stock certainly has turned down. We've seen negative divergence from the market out of Western Digital relative to the S&P, the Nasdaq 100, a lot of the leader names like Apple, as they pushed to new highs just recently over the course of the past week or days even or so. Western Digital simply has not been able to do so. So that is a sign of weakness from a relative strength perspective. Also absolute weakness by moving into a negative trend, and that's why we see out of the 5 attributes, Western Digital only has one positive attribute out of those 5. Shifting gears a little bit, when we think about the kind of reopening of the economy trade, the airline stocks were right at the forefront of that. You saw a lot of the airline stocks, a lot of the restaurant stocks, a lot of the consumer stocks, the stocks that people were going to now be able to go and spend money on once again, and travel was opening back up. And there were tremendous moves out of a lot of the airline stocks. These are 2, American Airlines and Delta Airlines here in the U.S. That were right there at the forefront of that, coming off lows. I mean, American Airlines went from in October of 2020 was trading for $11 a share, made it all the way up to $26 a share by June of this year, and has pulled back to some near-term support in the high teens, around 18.5. Making its way back up to 20. But in doing so, as we've seen this pullback and the market continues to push to new highs, we've seen a little bit of relative weakness out of that. So we've seen that technical attribute reading drop down to a 2. This is a stock that if it moves down to 18, will move back into a negative trend. So that'll be something that we're going to watch. Delta has already moved into a negative trend with the move to $38 on the right-hand side there, violating that red dotted line, which is the positive trend line, and so is violated that and now moved into a negative trend. And so, while we're talking specifically about these 2 stocks, I think they're important as we move forward through the second half of 2021. as we continue to see new data, new guidance on COVID cases come up around the world. I think one of the big questions is the reopening economy trade going to continue to follow through, or is there going to be a regression as it relates to that? And while we're continuing to see strength out of some of the large cap tech names, we're now seeing weakness. We're seeing technical breakdowns from some of these consumer names, from some of these stocks that really were benefited by the reopening of the economy. We're also the same stocks that were hit the hardest as the economy closed down back in February and March of 2020. So, right now, certainly seeing that weakness out of a couple of these airline stocks specifically, but also some of the other theme stocks, whether it be some restaurants, some hotels, some cruise liner stocks like those. But those will be important to watch. And Delta already moving into a negative trend. American Airlines very close, $18. Would put that back into a negative trend. And on that kind of same vein, as we think about consumer stocks, another, well, not airlines, shifting gears, kind of that whole idea of the consumer side of things. TJX operating a lot of clothing stores amongst different brands, and Ulta Beauty operating stores that sell cosmetics and the likes. These are stocks that we would consider to be technically weak stocks. TJX at a 2 attribute name, Ulta at a 1 attribute name. TJX has some near-term support. So this is a stock that, while relatively it is has seen some weakness from an absolute trend perspective, the overall trend remains positive, and the stock has a good amount of support in the lower to mid 60s. So this is not a name that we're seeing break down technically on its point and figure chart. A move to 64 and really 63 would be a pretty notable breakdown for the stock. But this is something that is still in a long-term positive trend. $70 would be a buy signal in the chart, would be another positive trend. Again, on the other hand, the key level on the downside that I'd be watching is a move to 63 to see that trend turn negative and violate some near-term support. But again, you'll notice that this is certainly a stock that has not participated, has not been a name that has been at the forefront of leading the market indexes to new highs, as it peaked in May and has not been able to recover since that time period. On the right-hand side, Ulta, again, in that retailing sector, Ulta has moved into a negative trend. It's rallied back up to some resistance here in the 356 to 348 area. It's facing some overhead resistance. It's challenging to try and get through that resistance. If it does so, it can move back into a positive trend. But right now, it's in a negative trend, facing some pretty notable overhead resistance. A lot of those, retailing names, the airline stocks, as we mentioned earlier, we're seeing pretty similar pictures in terms of weakness and negative divergence out of some of those individual names. And lastly, I'll mention in the financial space, as banks and financial companies really have very quietly done well this year amongst a lot of volatility amongst interest rates. I mean, we saw interest rates surge, move much higher earlier on in the year, which historically is a positive sign for banks. And a lot of the banks have benefited from that. We look at Bank of America, which is a 5 attribute stock. So, a high attribute name, that's as high as you can get on a rating system from our technical attribute rating system. It has pulled back a bit. It's rallied. It hasn't moved to new highs with the overall market, but it still remains in a strong positive trend. It has pulled back into oversold territory, which, if all else being equal, I prefer to buy stocks that are in oversold territory because they're not overbought. They haven't gotten overheated on a near-term basis. They've actually pulled back a bit. They've kind of relaxed and exhaled and remain in a positive trend and on buy signal, seemingly looking potentially for a next move higher in there. So Bank of America is a stock that we would put into a strong technical attribute name with a 5 attribute rating. So with that said, I know that was a lot of information and going through a lot of stocks. The information that you see here, this is just a number of data points that we look at and we track on individual stocks, in addition to tracking the individual charts themselves. If there's any information or you want to find out more information, feel free to go to our website, which is dorseywright.com. You can sign up for a free trial, or you can send us an email. Our email address is down there at the bottom of the screen as we're looking at it today. So with that said, I will just say thank you again for taking time to join us. Thank you again for having me. I will turn the call back over here, but we'll certainly stick around if there's any questions that I can help answer later.
Thank you so much, Jay, for that very engaging presentation. Now, please welcome our next speaker for tonight, Bertram Lai. Over to you, Bertram.
Hi, good evening, everyone, and thank you very much, Jay. It's very excited this evening to talk about where CGS-CIMB is able to add value through our very strong fundamental research, which is provided through our research partners in the US, Raymond James, as well as a strong technical analysis from our analysts on the ground in Singapore, Jeremy. So we believe that the combination of the two is something that we can very uniquely provide to our clients in Asia. So tonight I'd like to start with a broad discussion of where the US market and economy are currently positioned and lead into the key investment themes that this drives going forward. Then I'll talk through several stock selections based upon both that fundamental call together with our technical analysis. Now, one thing to note is a lot of these names are going to be of smaller market cap and may probably be less familiar to investors in Asia, but it is useful, I think, to see these as they underlie a lot of what we see in the news and in investing forums within the US. So I like to start here by trying to figure out the position of the market. And I think what we are seeing is that currently the US equity and bond market seems to be pricing in a forthcoming demand weakness. Okay, but what's important to note is that this is very disconnected from what we're hearing from company management teams as they provide forward guidance. So what this chart is actually showing is a correlation between where sectors and indices are in June and July of this year compared to January and February of last year, when COVID very much was a fear that was starting to percolate into the markets, but had not yet priced in the reality of what was going to happen in the US. So this chart is actually showing that the correlation of the relative returns of sectors between June, July this year and just when COVID was starting last year is at a pretty astonishing 88%. And this has increased over the last several weeks. So the way the equity and bond markets are being priced right now is very similar in the sense that they are afraid of a upcoming demand slowdown around the world. But actually, we think that this is going to be very different this time around from a public health perspective. So again, if we take a look at what's happening around the world, and in this chart here, we're actually seeing UK 7-day average COVID infections, which is shown by the red line, and then COVID deaths, which is actually shown by the blue line in this chart. Now, firstly, we may have already seen a peak in the UK infections, or this peak is likely to occur over the next couple of weeks. How do we know this? Most infection curves across the world have lasted about 8 to 12 weeks from beginning to peak, and we're about in that time period for the UK. And in fact, the 7-day average of cases now appears to be moderating. And then, ultimate reopening could actually extend this peak by another week or two. Okay, in the US, if you take a look at some of the early counties that were hit by the Delta variant, so in Greene County, Missouri, for example, this county is now approaching that 8-week time frame again. And again, its 7-day infection rate is starting to moderate, okay? Because the US is large, and of course, because Delta variant is seeing different curves in different counties, as a whole, the US may not peak as a country until September. However, again, what you're seeing here is that the impact on the healthcare systems is a lot lower than it was in the initial waves that we saw last year. So if we look at the UK hospitalization and mortality data, hospitalizations across the US, across the UK are now approximately about 16% of what they were in January, although the cases are now 80% of what the January infection levels were. The mortality rate right now in the UK is about 0.21%. And this is actually starting to get in the range or in the ballpark of the mortality rate for the seasonal flu as a percentage of infections. So right now it's about double the mortality rate of the flu that we normally get. Those getting infected tend to be younger, and those that are older, and hence more survivable, and those that are older tend to be vaccinated at this stage. So what this is telling us is that when it comes to the potential demand risk, that there is probably going to be little rationale for lockdowns, right? Especially now that vaccines are available. The unvaccinated are definitely getting sick as the economy opens up, and this does spread to some of the vaccinated population. However, it's been shown that vaccinations do give a high degree of protection from the vaccine. So what we are seeing is that hospitalizations are much less widespread than the wintertime wave. Okay, there may be some restrictions brought in certain areas, but overall, at least we're not seeing this rational basis for a full-fledged lockdown as we saw last year. In the meantime, of course, the economic data continues to roll along. It seems quite strong, and together with peaking infection waves, probably by the end of the third quarter, we're seeing, and hospitalizations under control, we're probably going to see a positive third quarter going ahead. Now, I do need to stress that Asia is in a very different state right now. So, as we know, in Asia, we were able to control the original COVID spread through lockdowns. However, given that Delta is a lot more infectious and vaccination rates in most Asian markets at this point are still very low, then lockdowns are probably going to occur, and they're probably going to be less effective than we saw last year. And there's already some evidence of that. We see traffic data slowing down, and of course lockdowns in many of our home markets. And of course, the other thing is the markets themselves, the stock markets, have reflected that, with most markets down around 5% compared to the S&P since May. Now, what this chart is actually showing is a chart which is actually maintained by Raymond James. This is an economic reopening tracker. And I think the key here is to look at the level where we are today compared to where we were in January. And it does show that actually there is a greater proportion of the world population that is locked down today than was in January of this year. So definitely a lot of that is occurring in Asia, India, Bangladesh, Indonesia, Vietnam, Thailand, Malaysia, and that is going to affect, rather than affecting demand, what we're actually going to see is that this is going to affect supply. So a lot of the supply chains are being disrupted, and that is actually going to lead to issues for some US companies. So one example would be the lockdown that has been put down on Unicem's factory in Malaysia. So they're now subject to a 2-week lockdown, and that will actually lead to probably some supply chain constraints for companies such as Skyworks in the US. Okay, but again, so this is really just to contrast the difference between the two COVID speeds that we're seeing in Asia versus in the US and in Europe, where really it's not going to be a question of demand, which is what we saw last year. The risk, I think, for markets in third quarter is really going to be one of supply. I won't spend too much time on inflation. I think that's being well debated right now. But this chart basically shows the real 10-year Treasury yield. It's at a negative level, something which has occurred very rarely in the past, and something which has reversed extremely quickly. So there's two ways that this can reverse, of course. One is if inflation comes down quickly. I guess that is one of the risks that the market is facing. We do think that there is a certain transitory state to inflation, that a lot of that inflation is being driven by the supply side as opposed to demand, and hence that falling of the inflation rate may lead to a normalization of real yields in the next few months. Of course, the other way to normalize yields would be for interest rates to be raised. Again, this is something which is an ongoing debate and which will probably drive further market volatility in the second half. Now, I wanted to, I guess, put our stocks that we're going to speak about in the context of the major themes that the strategists in the US are actually seeing. So I'll run through these very quickly at a high level. So one of the big themes that we saw coming out of COVID last year was deurbanization. So definitely there's been a marked movement of the population away from the denser, higher priced real estate areas within the US, moving mostly to single home and to less dense urban areas in the US. And this has actually driven a boom in the US housing market. This has obviously had repercussions throughout the supply chain. We've seen timber prices reach all-time highs. That's come off a little bit, but definitely this migration of the population to less dense urban centers is something which is continuing. And there are definitely stocks that will continue to benefit from that. The second area, and this speaks a little bit to what Jay was mentioning in terms of, the market has been very focused on the mega cap tech stocks for quite some time. And as a result, there are some very good fundamental companies where valuations are low, but the analysts and the company managements are seeing improving ROEs going forward. So these are definitely something for investors to look at, especially if you are getting nervous around that concentration of the market around the mega cap tech names. Third, reopening beneficiaries. So again, this is an area which should be of interest if you do believe that this Delta variant is going to peak sometime in the coming couple of months. So we saw how quickly the reopening beneficiaries did re-rate several months ago. That has now come off around fears of the Delta variant. But again, these become an interesting play as we move into the end of the third quarter. And then lastly, infrastructure beneficiaries. So right now, I'm sure all of you are aware that in the US, there's a great debate going on to try to pass an infrastructure stimulus bill. Build Back Better has been one of the key platforms of the Biden administration. And I think what the strategists in the US is actually seeing right now is this current outbreak of Delta is actually perfectly timed to help ease the passage of a larger stimulus bill. So compared to the spring where there was worries about inflation, etc., there was a lot of debate about how big that stimulus bill should be, or even whether one was needed. And I think the Delta variant is something which would actually help with the passage of a larger stimulus bill. Okay, so let's move on and talk about the stocks that we see benefiting. So in terms of deurbanization, our first stock here is Lennar Corporation. So Lennar's is basically a developer. It was originally founded in Miami, but today it's one of the nation's largest home builders, with a market share of nearly 9% of all US new home sales. They do a variety of housing products and price points. I guess from a fundamental perspective, this is definitely a stock where the analyst is seeing another quarter of very significant upside on earnings. So initial guidance was to basically for record-setting margins going forward. The company itself is carefully managing its new home starts and order growth in order to maximize its operations. Right now, as you can imagine, supply is under quite constrained levels given construction delays, yet demand is actually very high. And so what the analyst is seeing is that pricing power has really exploded higher for Lennar's. From a technical level, Jeremy is seeing that the uptrend is well supported, and he recommends an entry at around $95 to $100 and about 15 to 20% upside from those levels. Okay, the second deurbanization pick we'd like to highlight is KB Home. Now, KB Home is headquartered in Los Angeles, California. It is one of the most geographically diverse home builders in the country, and the company offers a broad variety of products, very much targeted at first-time or first move-up home buyers. Okay, the products actually include a lot of detached single-family homes, which we know has been one of the focal points of this deurbanization trend. So again, the company reported second quarter results and guided for a very strong upside, and this has led to upward revisions across the street. Now, the shares actually have pulled back, as you can see, about 20% since mid-May. And this is based on concerns that demand may be slowing or that delays in community openings would actually slow down that revenue potential. However, the analyst has actually conducted channel checks and I guess the finding has been that while some of those elements are actually occurring, that actually the rate of price increases is still extremely high. So at this point, at current valuations, the stock is undervalued. And from a technical perspective, we're seeing that this price action is actually bottoming out and that there's a breakout potentially underway. Okay. First stock in the discounted valuation and improving ROE theme is AutoZone. Now, AutoZone is a company that's headquartered in Memphis, Tennessee. It is the largest specialty retailer of automotive aftermarket products in the United States. So it actually services both do-it-yourself customers as well as commercial customers who prefer the service, the do-it-for-me market. The company has about 5,800 stores in the US, 600 in Mexico, and also extends down to about 40 stores in Brazil. Now, AutoZone, again, we've seen, I guess, a growth in the secondhand market for autos, given people have been delaying purchases of new cars, and this has really helped in the aftermarket spare parts. Now, the company has delivered stronger than expected third quarter results, and the analyst in the US is anticipating continued strong quarterly growth. So again, from a technical level, our analyst is seeing that while the uptrend remains very strong, the shares are currently overbought, and there could be a near-term correction. So we're recommending that that investors do look to buy on weakness, entry point around $15 $100. The second stock that we'd like to highlight in terms of this discounted valuation improving ROE is Triumph Bancorp. Now, this is a banking company based in Dallas. They focus on, it's basically a community bank throughout Texas, Colorado, Illinois, and Iowa. Okay, now the company itself is seeing much more stronger fee income and is also benefited from a lower tax rate. And going forward, we're expecting to see net interest margin and net interest income also beat consensus expectations. From a technical level, the shares have hit the support level at around $70. The uptrend should be intact, and we're expecting a breakout higher to happen potentially. So investors should be able to enter here and take profit at around the $85 or $97 level. In terms of the third theme, reopening, there's a couple of stocks that we would like to highlight. The first one is D.R. Horton. This is a company based in Fort Worth, Texas. It is the largest home builder in the United States. It's delivered nearly 57,000 homes in 2019. And again, they've very much focused on single-family homes. They operate in 80 markets across 26 states. Now, inventory, as we have mentioned, is a constraint across the industry, but demand is still remaining extremely strong. So hence pricing power for this company is extremely strong. The company is very focused on capital efficiency, and the analyst is projecting forward ROIC of 29% and an ROE of 33%. Okay, the company, the shares have actually seen a recent breakout above the downtrend line, and we think this is extremely bullish trend change. Okay. The second stock we'd like to highlight is National Retail Properties. This is a company that's headquartered in Orlando, Florida. It basically acquires, owns, and develops freestanding net lease retail property. The company owns 3,000 investment properties located in 48 states. So the analyst is seeing this as a late-stage recovery play. The company has been guiding very conservatively, and given the reopening theme that we are expecting to continue, the guidance is probably going to be raised going forward into 2021, into the rest of 2021. Company is still trading about 10% off its 2019 end-of-year price. So we think the uptrend is very well supported at the 20 and 60-day moving average, and we are likely to see further upside for this stock as well. The last stock I'd like to talk about, is a little bit more fundamental, is Evoqua Water Technologies. It's a company based in Pittsburgh, Pennsylvania. It's one of the world's largest providers of water treatment equipment, systems, and services. And the company operates in a couple of business segments, both in terms of integrated solutions and services and applied product technologies. Now, those of you that have been reading the news in the US will know that actually water infrastructure modernization is a major long-term theme. It is part of the infrastructure package put forward by President Biden. So the company itself is actually the largest public pure play on water treatment technology. It's not a sector which I think many investors focus on, given that it's a very fragmented landscape. But the company is using its very strong cash flow to do a roll-up strategy. So M&A is likely to see this company further consolidate that market. Now, the Biden infrastructure plan has set aside $111 billion for water infrastructure, and a key objective is to replace all of the water pipes containing lead. There's a further $45 billion initiative, which upsizes the existing programs of the EPA. There's also another $56 billion in grants and loans to modernize drinking water, wastewater, and stormwater systems. So definitely this is a company which is well levered into that infrastructure package. Okay, so these are, I guess, the fundamental recommendations that we see. I'd like to pass back to Ping Mei now, but definitely happy to take any questions that you may have.
Thank you very much, Bertram, for that insightful session. Both you and Jay have certainly given me, and I'm sure the audience, a lot of ideas for when the US market opens shortly. So here we are at the Q&A session. Let's see if we have any questions coming in. All right, first one. Jay mentioned that large cap growth stocks are making a return recently. What are the trends or events driving this? And is this sustainable for the short term?
Sure, it's a great question. You're absolutely right. I mean, the large cap growth theme, it really has been a dominant trend for the past 4 or 5 years until about the last quarter of 2020 and the first quarter of 2021. I think you saw a lot of those stocks just simply take a breather, whether that was profit taking by investors as they were focusing on some of the more value-oriented plays, such as the reopening economy, or whatever the specific reasons were during that time period. Really in the second quarter of this year, and as we're moving in through the third quarter of this year, you're seeing a lot of the technology companies, a lot of the big cap technology companies really are the ones that are the big drivers of the returns so far this year in the market, overtaking a lot of the smaller cap and the value stocks that carried kind of the first quarter of 2021. But it really has been a story, I think, about investor demand for looking for some of those growth areas and some of those just large cap technology names that have their tentacles. They have business lines in a lot of different sectors, a lot of different areas to be able to benefit as the economy continues to reopen around the world.
Thank you so much, Jay. Let me see, next question. Okay, so earnings are improving across many companies with the economic reopening. What are your top dividend stock picks? Perhaps Bertram, do you want to go first?
Oh, that's a good question. I think in terms of income, I think that has been a theme that came briefly into favor, and it's definitely something that we think investors should look at. In terms of specific stocks, I don't think I have any to share at this stage. But what I would say is that definitely we see a lot of capital recycling given low interest rates right now. So when you look at companies like the REITs, there's actually a lot of M&A activity which is occurring. So definitely on the REIT side, I think the focus for investors should be on companies that not only pay a strong dividend, but is actually able to, I guess, grow their assets through M&A activity. So I think, you know, within the stocks that we've spoken about, the National Properties is definitely a company which has got that capability, and I think. You know, as far as looking at income, that probably is something which I think investors can turn to towards the end of the third quarter.
Okay, Bertram, what about you, Jay? Do you have any dividend stock picks for our audience?
Yeah, I would say I would agree with what Bertram just said on the REIT side, the real estate side. I think there's been a lot of interesting opportunity and dynamics that have happened within the REITs. Bertram mentioned, I know one. Another one that I would mention in that space would be CIMB Growth Properties. Is a stock that is a REIT that's a good dividend paying stock. That is, from a technical perspective, a strong technical attribute name. So in terms of that would be one individual name that I would look at. One I mentioned earlier in the discussion is in the financial space, specifically Bank of America is a stock that is technically sound. That is, a stock that, banks in general have actually been, or financials in general have been very strong this year. They have benefited from rising interest rates, and they've benefited from other regulatory items that have come out around capital requirements and the likes. So there's a number of financial stocks. Bank of America certainly is one of them. And then another name that I would mention it hasn't really been talked much about in the either these discussions or really discussions out there, but is within the insurance space. And insurance at large isn't a sector that we would look at and say that's a great sector. But Prudential Financial within that group is one that has been very, very resilient over the course of the past couple of years, is in a strong positive trend, pays a very nice dividend. And so that's one that I would certainly look at. But, I think the income theme just in general, I think there's a lot of opportunity in some of these names, but in equities in general amongst dividend paying stocks, just, given the low interest rate environment that we've been in, equities continue to present positive, strong opportunities for some income names.
Thank you so much for those names. Since we both mentioned REITs, there is another question here on REITs, and I think this one will resonate with the Singapore investors in our audience today. Are US REITs a better investment than Singapore REITs? There is a 30% withholding tax for dividends for US REITs, while there is no dividend tax for investors of Singapore REITs. Maybe Bertram, you'd like to take this question, since I think you're quite familiar with the Singapore space.
Yeah, thanks, Ping Mei. I would answer that in a very similar way, which is, definitely when you invest in a REIT, there are two components. It's not just pure income or pure dividend. I think what we're seeing now is the ability of REITs to actually grow their dividends is going to be a key focus, given that low interest rate environment. I would say that there's a certain amount of fear of inflation as well, right? So definitely investing on a purely dividend basis may be an issue should inflation start to pick up. But I guess comparing US REITs to Singapore REITs, I think there are strong picks across both markets. I think definitely, for example, in Singapore today, we did upgrade Keppel DC REIT. We are seeing, I guess, more M&A activity and interest in data center REITs. So I think the opportunity occurs across both markets. Definitely having that tax benefit in the Singapore market is positive, but I would actually focus much more upon their ability to grow dividends going forward.
Okay, thank you so much, Bertram. Let me check. Okay, another question. This one, probably for you, Jay. Airline stocks have been making a comeback and earnings are recovering. While the vaccination drive has allowed the economy to reopen, the pandemic is not over. If new variants were to emerge and create new waves, will airlines be at risk of another sell-off?
In short, I would say, yeah. I would say yes. They're certainly at risk for another sell-off. I wouldn't say anywhere to the magnitude or extent at which we saw them sell off last year, but certainly there's a risk there for sure. And we talked a little bit about that with American Airlines and with Delta in the earlier discussion. Delta Airlines has already violated its trend line and moved into a negative trend. American Airlines is currently testing some pretty key support, so we'll continue to monitor those. So I would say, yes, there's absolutely risk in there. I would say those are stocks that are in many ways testing those support levels. So they're very much worth keeping an eye on. I can tell you from a firsthand experience, about 2 weeks ago, I got on a few airplanes for the first time in a little over a year, and the planes were at full capacity. And so at least as of a couple of weeks ago, there's certainly around the U.S. there's still travel happening, but we'll see. We'll have to continue to watch and see what happens with the cases, and as if you see a lot of cases rise, then you certainly might see some of that travel demand, the pent up demand, go away. And a lot of the airlines, from a policy perspective, have gotten away from charging cancellation fees. And so if things in the economy do become bad or much worse with the rise in cases, it'll be much easier for people to cancel those online reservations without penalty. So again, yes, there's a risk. We see that, testing the support. I don't see the risk being as big a sell-off as we saw last year. And to Bertram's point, if you start to see those curves kind of begin to flatten in the number of cases on the average cases, they could end up holding support and move back into positive trends. But it is certainly an industry that is worth watching very, very closely, and I'm sure everybody is watching the economy and the case numbers as it relates to those.
Thank you very much. I think we have one last question, also related, I think, to the pandemic. This is regarding the theme of deurbanization, as mentioned by Bertram. While the pandemic has shown that work from home is possible, will this trend really continue now that the economy has reopened and there is news out there that some companies are requesting for employees to show up in office again? So is this really a short-term thing, or mid to long-term we expect that trend to continue? Any thoughts on this?
I might defer to Jay here, but I think given that you're on the ground there, but definitely I think there's going to be a mixture of companies requiring employees to be back in the office, but also some companies taking the opportunity to lower costs and to have employees work from outside the office. So definitely that's what we're seeing in Asia. I think, the lockdowns have actually meant the companies have become equipped to actually allow that style of working going forward. But no, I'm interested to hear, Jay, your view on how it's progressing in the US.
Yeah, I think in the near term, I think there's going to be a lot of companies that are going to continue to operate from home. I think in the long term, you're going to see some type of hybrid approach where there's going to be a requirement, or at least by functional groups, to be in the office 3 days a week, and the flexibility to work from home 2 days a week, or some kind of flexibility from there. I think we've all shown the ability to be able to work from home. I think there's it seems to be a strong desire from some employees to want to get back into the office, and a strong desire for some employees to say, look, I'm as efficient and as good as I can be while I'm working remotely. I don't need to commute an hour and a half every single day into an office. I can do that maybe once or twice a week. And I think you're seeing now a lot of companies come out, and at least what we're hearing is that offering some flexibility. There is the other extreme of some companies came out 6 months ago and said remote work is the way of the future, and all employees will be remote workers. And that was, a lot of technology companies came out and said that. So I think the reality, though, is I think you'll end up seeing a hybrid where there's a good portion of people back in the office for a majority of the time, with some flexibility to work remotely a few days a week.
Thank you so much. Okay, with that last question, I think that wraps up tonight's session. A very big thank you again to both Jay and Bertram for your presentations and all those insights. I am sure our audience has learned a lot from the two of you.